So, I did want to talk about the markets. Just reflecting on the year. The effective tariff rates on imports, highest they've been since the 1930s. Right? That's the effective tariff. No one.
That's amazing, isn't it?
It
is starting to come. It is working its way through.
Oh, it will work its way through.
For sure.
But it could change in minutes, truly. In minutes.
Well, no, Trump is so predictable. What do you mean?
The biggest companies out there, they're S&P 500, largest companies in the S&P 500. They feel like they're a little bit insulated from.
You look at the earnings growth, Pat. People are expecting Q2 to be about 5% for the broad stock market. Yep. We're coming in north of 10, like 12%.
This quarter, more than 40% of companies in the S&P 500 index raised their earnings estimate. 40%. In the first quarter of this year, 17% raised. And so what all that is a company actually giving guidance.
They always sandbag a little.
Really?
Right?
Yes.
I mean, you think you're going to earn $100 million where you're like, let's sell. We think we're going to earn 92. And that way, if we do better, we get rewarded as opposed to being punished.
Yes. So at the end of the first quarter, 17% of companies raised their expectation. The end of this last quarter, 40%. And it's hard to point to. The retailers and restaurants are really struggling with the tariff situation, but
certain industries are
most certainly. But the implementation of AI is really, really actually taking place.
Well, it's what's fascinating, Pat. You look at the like NVIDIA and the companies, some of these companies that call themselves AI companies. You look at the market caps of these things, right? Then you look at these pay packages that
they're paying.
These hotshot engineers are getting paid to come work for Mark Zuckerberg or whomever, right? Like it's kind of crazy money. It's all going to have to trickle down into more productivity and more profits for the companies that are paying for the services, right?
That's right.
Because you're not going to pay for a technology unless it's going to give you a return. No matter how cool the technology is, if it can't give you a return, you're not going to bother spending the money as a business.
That's right. It's
all a business.
But it's.
The bet is that the pull through on this is going to be substantial.
And then you think, well, is this the .com all over again?
It
doesn't feel.
There might be some companies priced that way, but
yeah, but
even the .com is transformational. Look how we buy and sell.
Yeah.
I mean, just my oldest daughter was thinking of moving. She's in Denver, thinking about moving back to Truckee. We met with a real estate agent not too long ago, in his office, and kind of curious about different neighborhoods. All on a screen there, different neighborhoods. All of course
in the car.
No, and then it's then here's the houses that are available. Here's the ones that had sold before, and in an hour, what we accomplished in an hour, sitting in the office looking at a big screen, would have taken us a few days 25 years ago.
Yeah, at least for the initial screen.
And that's not even AI induced.
It's interesting. I was just reflecting this morning on it, and I just thought and then I just remind myself, this stuff happens all the time. I just forget about it. Then the market's just like at the beginning of COVID, how quickly the market fell and how quickly it recovered.
It's been an amazing time because our downturns have been so short-lived.
Right. And what do you think? Is it by the dips that the investing public is just...
Well, if you think of the last two major downturns, right? So the .com, what we had there is overhyped companies that there was no there. There was all hype. They had a web presence, .com. They hardly had any employees. They had no revenue. They had no real business model.
And then it hyped up the rest of the market.
And there were mutual funds. That was still a big mutual fund day where grandma in Kansas City would put money into a mutual fund. Essentially, it was a wealth transfer from individual savers to some of these .com creators. When that blew over, That created a big downturn. Add 9/11 on top of that,
Okay.
because that was about halfway through. Is then suddenly we had 9/11. So there were some real headwinds, and same thing with the financial crisis. That was
real. That wasn't an emotional reaction
No.
to something that was going on.
There were millions of homeowners that had mortgages that became worth more than their homes. And
Oftentimes from the day they purchased the home.
Okay, but it created this downward spot. And so we've not had anything quite like that. We had COVID, but that was short-lived. Government stimulus kind of helped bridge that gap. We knew we weren't going to all die from the virus, so once that was clear, things rallied back up. And then, this tariff thing, I think people realized pretty quickly that whether you like the tariffs or not, and the way it's being implemented, it's not going to blow up the economy. And you can always reverse them.
Yes,
Things get slow, you can reverse them. It's not like the housing crisis that's in a free-for-all.
Yes.
So I think that's until we have some structural issue.
The markets, there'll be buybacks. These were
my guess.
Emotional reactions
But
to
look,
the marketplace.
But as soon as I start to believe I have some idea of what's going to happen in the future,
Yes.
as I was talking,
You'll become a terrible investor.
This real estate agent a couple of days ago,
he told you.
Well, no, we'll see interest rates next year, and
he said that to you. Where they're going to go?
And I stopped and I looked at him. I said, "You know where interest rates are headed?"
What he said?
Because I almost said, because if that's the case, if I knew where interest rates are going, show us the biggest house here.
Like why are we stopping? Let's look at the $50 million houses. Did he have interest rates going down?
Of course. Oh, yeah, they're going to be. If you need a loan, you can be able to refinance in a few months for less. It's no. By the way, when someone tells you the interest rates are going to go up or going to go down, it's no different than someone telling you where the stock market is going to be in 6
This
to
guy
12
was
months.
pitching me a real estate portfolio. A friend of a friend was like trying to tell me, okay, he's buying all these houses in Idaho. He said, yeah, we're going to refinance these homes in 3 years at 4%.
That's their business model.
Yeah, I said, yeah.
What if the interest rates are 10% then?
Scott, they can't be.
You realize interest rate, like mortgage interest rates, if you go back 50 years,
They're historically still low. Yeah. But anytime that they throw out these projections.
Because I remember my first home, we bought a home in 1992. I believe it was 7.75%, if I'm not mistaken.
Mine was north of 9, my first home. Yeah.
A couple of years before I did. Yeah. And that's when the rates were coming. Anyway, why are we talking about our home?
Yes.
Home mortgage is not. But,
right, well,
but the thing about, I think the thing to always remember about the markets, like, you cannot predict the future. And just because things feel great right now, nasty times are going to come.
That's right.
And we don't know when.
Whether you're Democrat or Republican. That's right. Whether your guy's in office or not in office.
That's something bad's going to happen. The markets are going to go down.
And then the U.S. economy is going to take a hit. And then everyone's going to be a reset a little bit. And then smart people are going to figure out how to go back and make money.
And the market's going to recover again. And
Again.
we'll hit new highs.
Again.
The Dow Jones Industrial Average is what, roughly 45,000? When I started in the industry, 1990, July of 1990, it was roughly 2,600.
Yep. It's a lot. It's increased quite a bit.
It's increased.
You joined the industry in what?
Phenomenal.
1920?
1990, July of 1990.
Good reminder.
Was it August? July of 1990.
You crawled a wall of worry, is what they call it in investing.